Welcome to Options Trading 101. My name is Shai Chaudhary. I'm a Senior Program Manager at Microsoft. And this presentation will cover the basics of option trading, and we'll also go a little more detail on specific types of trades. A quick disclaimer, I have done this presentation 3 times before for some internal teams I work with. And this disclaimer is just to let you know I'm not a financial advisor or a tax advisor. So please consult a professional if you do trades of your own. This presentation is not personal financial advice for you. It's just my personal experience and knowledge that I'm sharing here. So any and all feedback is welcome. If there's something you agree with, great to get some thumbs up. If you feel differently, also feel free to share that as well, because I'd love to hear different viewpoints. And as you've always seen, past performance is not a guarantee of future results. Now, I will pause between each of the sections, and I will be taking questions if there are any. And I also have my phone open on my side with the chat window, so in case folks want to type in questions in the chat as well. So on the left here, what I'll cover is options trading basics. I'll cover calls and puts, which are the 2 types of trades you can do with options. And specifically, I'll cover selling covered calls and also selling cash secured puts. And you can also buy calls and puts, which we'll discuss briefly as well, just to define them and see where they're useful. But I'll go deeper into covered calls and cash secured puts, which is what I do personally. And because this is a personal story, I'll share my strategy, what I've been doing as well. And finally, we'll wrap up with how options are handled in Fidelity. So you'll notice up until now, there's no mention of Fidelity, so that everything you learn up until now can be used on any platform. And we'll cover Fidelity because most folks in Microsoft do have Fidelity, and you have the ability to sign up and get options enabled. Now, on the right side, I mentioned what I cannot recommend for you is individual stock picks. So I'm not here to pick a stock that's a winner. I'm not a fortune teller, so I can't tell you what will go up, what will go down. I can't tell you what stock price to buy or hold at, or what stock price to sell at. That's something that you'll have to do your own due diligence, decide on your own. I will not be recommending naked options where your options are not covered by any cash or stock collateral. And I will not be recommending margin trading either, which is where you get a loan from your brokerage and there's interest that you owe on it. So I won't be covering that as well. It's only covered in secured trades. All right, so let's get on to the basics. What are options? An option is a derivative which has some underlying assets such as a stock. Now you can think of an option contract as something which has a buyer and a seller. There is a strike price associated with it, and there is an expiration date associated with it as well. For the duration of this presentation, we'll talk about American style options, which allow you to exercise your option contracts earlier than the expiration date. So you can do it early on the expiration date. There's the European style option as well, which you're only allowed to do it on the expiration date. We'll not be covering that. So for the most part, we'll cover American style options. Now you'll see here in the 3rd and 4th bullet point, I mentioned that the buyer, who is the holder of the option they have purchased, the buyer has the right to buy or sell the underlying asset because they're the one who are paying the money for the option premium. That gives them the right to buy or sell the underlying asset. And the seller, or also known as a contract writer in this case, has an obligation to buy or sell the underlying asset. That means that no matter what happens, once they're sold a contract, whatever underlying asset there is where they have to buy or sell the underlying stock, they have an obligation to buy or sell. They can't choose either way. Again, we'll talk about pros and cons of each. And you may be wondering at this point, well, when do you buy or sell an underlying asset? So we'll cover that in more detail on what it means to buy or sell a call or buy, sell, or put, and what it means for the underlying asset. But first, I did want to highlight that this is different from employee stock options. So if you're here to learn about the Microsoft stocks that we get from our employer, this is not the place. So that's a different story altogether. Here we're talking about options trading, particularly puts and calls. All right. Here's something I wanted to share really quick, a little bit behind the scenes with Options Clearing Corporation, or the OCC. So I included a source every time I've included some graphic or snippet from another website. You can read more about what this means to have some third-party intermediary. So they work as a clearinghouse where the option writer can write an option. It goes through your brokerage, such as Fidelity, but the OCC handles all these trades and they will match up writers and buyers. So later on, if you sell an option contract and you have to close it, you can close it without having to sell it back to buy it from the same buyer. So let's say you sell to open, and I'm going to use a lot of these terms to define it later. As a contract writer, you sell to open a new contract and you decide to buy it back early. You can do so because you're really interfacing with the OCC in the background. So again, a good thing to know ahead of time in case you're wondering if you need to be paired up with anyone in particular, but you don't. Now, there are two types of options. I've mentioned it several times in the intro: calls and puts. On the left side, you see call. It says buy option, pay premium. So that's a good way of summarizing what it means to buy a call option. You pay the premium, and the most important thing here is times 100. I've seen a lot of tutorials that omit this times 100, which is not good, because it's good to know that if a premium is $5 for an option contract, in order to buy that option contract or call, you have to pay $500 to buy it. On the flip side, on the right side, you see it says sell option, get premium. So if I'm an option contract seller, I'll immediately get $500. Now, that is mine to keep at the beginning, and I don't say mine to keep forever, because I might need some of that money to buy back a call later on. But you can think of selling a contract as getting your money up front. On the lower left, I have buy an option, which is a put option. You also pay a premium. And on the lower right, you see something very similar. It's a sell your put option, which is get your premium times 100. So again, if it's a $5 premium, you earn $500 for selling a put option. So what's the difference between a call and a put? Let's open each of these one by one. A buyer of a call option gets a right to buy a stock at an agreed upon price. Now that price is known as the strike price. Now, in order to have to buy a call option, you'll notice a green arrow here indicates that the call option buyer is bullish on the stock. Let's say they've agreed to buy the stock for $100 and they've paid maybe $5 premium for it. So that price is not $500 they paid out of pocket, but let's say the stock price goes up from $100 to $120. Well, they've now made some extra money in the trade, and they're happy they've made some money. Now, on the right side, the person who's selling a call contract, which is a covered call, which you've seen mentioned several times in the investment channel recently. What I'm doing as an option contract seller, when I sell a covered call, or any call for that matter, I have the obligation to sell my stock. So let's say I hold Microsoft shares, and I say right now, I forget what today's price is. Market's already closed today after 4. Let's say the price today is $240. I don't know what it is right now, but let's say it's $240. And I want to sell a premium to sell it for a slightly higher price to make some extra money on it. And I say that my strike price is $250, and I choose an expiration date. So what happens is that the stock price suddenly reaches $250 next week, or $260 and even higher. There will be a call buyer on the other end. Well, I'll not have any direct contact with them. They will exercise their right for sure, because my contract is what's called in the money. So when it's in the money, it means that they can get a benefit from exercising the contract right away. They've now purchased my stock for their agreed upon price, and now I'm kind of missing out on the extra price I would have gotten. So one thing to notice is that, and we'll cover this in a lot more detail, and how to pick a good strike price so you don't get assigned as much. So when you get assigned on a call option, the correct term is that your shares are getting called away. So in this case, I have an obligation to sell the stock. I can't say, no, I don't want to sell it after all. If I hit the expiration date and the price has gone up further than the strike price, then I will have to sell the stock. My brokerage will handle that automatically. And if by any chance the call buyer chooses to exercise that a little early, they can do that as well. You may be wondering, why would they try to buy the share a little early? That's because there's something called an ex-dividend date, where a call buyer might want to exercise their call option a little early, and they want to own the stocks from me a little earlier, and they will get their dividends in the next quarter. So that covers a little bit of what the call option is. I'll repeat a couple of these things because there's a lot of complexities involved. Let's go right to the puts. A put buyer has the right to sell their stock. And on the right side here, a put seller has the obligation to buy the stock. In this case, I might say that I'm selling a put on Microsoft because I think that a good price to buy would be at $199, and I'll sell a put for that. And then let's say if the price goes higher than that, and now the person on the buyer side decides to exercise their right, they can go ahead and buy it if they wish. And again, their intention is to make sure that they're getting a good price on their stock as well. Now we're going to go back and forth on calls and puts, and we'll describe the pros and cons of each. Now, this is a fairly complex diagram. It's called a profit profile, and it shows what kind of profit you could be making during the expiration date. So expiration happens on Fridays. So typically when you look at what's called an option chain, which we'll discover again in detail, the option chain shows for every option contract, you have an expiration date. And depending on what you're selling or buying, calls and puts, you'll have a profit profile of what your max profit can be, what your max loss can be, and Fidelity will make it very clear what your potential upside and downsides are as you're making the trade. Let's clear this up a little bit. This is a very busy screen. It shows the blue line showing calls that are being sold, and the yellow line showing calls that are being bought. And the BEV is break-even price. So let's take a look at this one. So hopefully this is a lot easier to look at now. There's only one yellow line in there. So let's say you're buying a call, and I've put the term long in it. Long is kind of an overloaded term in the stock market industry. In this case, when you buy a call, that's a long option, and when you're selling, it's called a short. So you buy a call, you're buying a long call. The reason that someone might want to buy a call, they're bullish on the stock they're trying to buy. I'd mentioned that before, but in this case, they do want to lock in a lower buy price. Most likely, after they lock it in and they purchase their stock at a good price, and the stock has gone up a lot, they can lock in their profit by selling that stock. The analogy would be a non-refundable deposit on a new home. Let's say you see a new development popping up, and you know it's a very hot market. The prices are going to go up, but they've offered non-refundable deposit for folks who want to lock in a lower price so that you can get the good price for that market. Now, as you know, the real estate markets sometimes may not go the way you want it to. So in this case, you may put your deposit down. It turns out that the neighborhood is not as good as you wanted it to be. Things are not selling. The market is tanked. Now you're locked in for a price, but maybe you have the ability to back out, and which is what buying a call could be. So you'll see in this profile here, let's say the strike price, and in this example, I'll say is $100. So you're saying that you want to put down a premium amount. So let's say the premium is $5. So I'll make up these numbers as we go. And your break-even price is going to be premium plus the strike price. So it'll be $105 break-even because you've already paid $5 per share. So since it's always in multiples of 100, you get to have a break-even price, $105 in this case. You'll notice the max loss here is the premium times 100. So you've already paid 500 up front. If the stock price goes down further, your profit profile doesn't show any further loss because you've only lost 500. In this case, if it's gone further down, you don't have to buy your stock at that price. Now, if the stock price is going higher, obviously you can buy it at your chosen strike price, which is say $100. And now you can sell it for whatever it is on the market right now. So that enables you to make that, and I say max profit question mark, different profit profile graphs, they might say unlimited. In reality, obviously unlimited, there's always a finite dollar amount, but if you keep letting it go up and sell it at a price you wish to, then you would have locked in a lower price, you can sell it for a profit. Again, that's a very detailed overview of what it's like to buy a long call. But we're here to learn about selling calls. So let's take a look at this. Now, as I mentioned, long is for buying, short is for selling. And in this case, it's kind of flipped over. You saw in the dual diagram, the blue line was there as well. Now you're looking at the blue line just by itself. Now, why would you want to sell a covered call or any sort of call for that matter? You can earn premiums in the stock you already own. There is another way you can still do this. If you don't own it just yet, you can do something called the buy right, where you're buying the stock simultaneously as you're selling the covered call. So even if you don't own it yet, you can choose to do that. I like doing covered calls because if I already own it, chances are most likely I'm selling it at a higher price because I have a very low cost basis from before. And we'll take a look at some examples for this as well. Now, the analogy for this is I'm the person who's collecting that non-refundable deposit for new home development. So think of it as the person on the other end of the buying of calls. Now, notice that the strike price, let's say, is $100 here, and that break-even price is higher than the strike price. Let's say in this example, the premium is $5. Now I've already earned $500 just for selling a covered call. And when the price keeps going higher and higher, now I have no choice. I have the obligation to sell this stock for $105 because that's 100 plus the premium of $5. So and notice many graphs that talk about this as max loss, so unlimited loss. Now, this is only if the stock goes to infinity and if you hated the price that you picked. In reality, chances are I will pick a strike price that's above my cost basis, so I'll make some money. Plus, I'll make that extra premium money, and I'm happy to sell it at that price. If you're not happy with that decision, I would not recommend doing that, selling a covered call at all, because if you're losing money on the trade and you expect to not be assigned, it doesn't work that way. There are times that you will get assigned, even if it's a small percentage. So this max loss can be minimized a lot simply by choosing a strike price that's higher than your cost basis, and also ensuring that you're happy with that price based on how you feel about the company and the stock. So again, it's up to you to do your due diligence. A lot of folks have done research on their own, the fundamental and technical analysis to figure out what you think a stock is worth, instead of just watching what the analysts say and listening to everything that everyone says, because different folks have different ideas of what direction a stock might go in. I did want to look at this left side as well. The max profit here, as you know, is just my $500. If I got $5 premium for selling this covered call, I only make $500. That's my max profit. But again, I'm okay with that because I know that I'm choosing to do this with low, what you call delta values. We'll cover more about the Greeks later. But delta value is my favorite Greek. It is a proxy for letting me know the probability of me getting assigned on my shares or not. So that covers both the buying and the selling of the calls on both sides. Now let's move on to puts. Just as we saw with the call option, puts are also on the opposite side of things, depending what you're selling or buying. Now, let's split this up so you can see both separately. It's easier to see. So here, looking at one graph at a time. In this case, the reason someone might want to buy a put is you buy a put as a protective put, a stock you already own. You can lock in a higher selling price. The analogy would be you buy insurance on an asset. Let's say you have an expensive painting, and you think that that expensive painting might be crashing in price, but depending on how the art market goes, and you want to insure it, and you want to make sure you can sell it at the agreed upon price. Well, in this case, you choose a strike price, let's say it's 100, and break-even price in this case is 100 minus 5, which is 95. So if the stock price starts to tank, and you can make a lot of money because you've already agreed to sell your stock at that strike price. So the break-even price is just strike price minus the premium because you've already paid that up front. In this case, if it's a $5 premium, you've already paid $500, which would be your max loss. So one thing you'll notice that you see a pattern here. The person who is buying the puts, since they have the right to exercise if they wish, their losses are capped at whatever premium they have paid already, and their profit can be unlimited. But here's the thing: if the trade does not go in the direction that you want, you could be just having maximum loss every time, and that will add up. So again, pros and cons for both sides. So now is a good time to look at the other side of buying a put, which is selling puts. Now, when you sell a put, I specifically mentioned cash secured puts. So in this case, you tell your brokerage you want to sell a put, and immediately they will lock in that cash as collateral. You could also do this without the cash being secured. I don't recommend that. I don't do that personally, so I won't go into it deeper. But one of the reasons you might want to do it is to earn some premium for stock that you might want to buy at a price you choose. Now, notice I didn't say that stocks you want to buy, because there's a chance you don't get assigned. So you shouldn't be relying on all your puts getting you assigned. Your goal should be to earn the premiums. So let's look at the chart again. And just like the selling of the calls, you're capped at your maximum profit. If you've chosen a strike price of 100 and your break even is $95, the maximum you can make is 100 times your premium, which in this case is $500. And in this case, you have to buy the stock for the strike price. So you've already made the $5 per share. That's why your break even is less. As long as it heads down to $95, you're still good. But if the stock price tanks, it keeps going lower, 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 you could have maximum losses. So in theory, whatever stock you buy, if it goes to zero or near zero, you'll basically have put yourself in a bad position by purchasing that stock at the strike price. And the only thing you made was that little premium money times 100. And now you're stuck with all these shares and there's nothing you can do about it. So again, do your research, make sure that it is a stock that you want to own at a price you want to own it at, and you can make some premium money in the process. The analogy is similar to the other one where someone is buying insurance for an asset. In this case, you're sort of selling the insurance. So you can think of option contract sellers as the people who are selling the insurance to the option contract buyers in this case. All right, so that was a lot of deep material covering a lot about puts and calls and what it looks like in either end. I did want to mention that this is different from short selling. You might see the term short and selling and think this is short selling. Short selling is something that someone might want to do when they're selling their stock that they don't actually own. They'll borrow it from their brokerage. There's margin involved. They'll owe margin interest. And if they're relying on the stock crashing, they can go ahead and sell the stock for the higher price. And then when the stock crashes, they're then buying the low price stock at a later time when the time comes. That can backfire, as you've seen with all these meme stocks you hear about in the news, where these hedge fund companies were literally going bankrupt because they were short selling stocks like GameStop. So that's not something we're talking about here. The closest thing to short selling and options trading slides that I've discussed is the buyer of the puts. So I mentioned that the person who buys the puts, they're now on the hook to sell it's sort of like a protective put that I mentioned. They have the stock that they own, but if they didn't own the stock, they could short sell as well. But that's, again, not something I recommend. And short selling is definitely different from selling short puts. Okay, so that's why I put short in parentheses. Let's talk about this as selling puts. Now, what are the outcomes that can happen? So I boil this down to two outcomes. When you sell a covered call, I grouped the at the money and out of the money as a single thing. If stock price stays at or below the strike price, when it is at the strike price, it is called at the money. If the stock price stays below the strike price at expiration, it's called out of the money. But you get to keep the shares that you already own. So let's say you own those 100 Microsoft shares and you sell a covered call for every 100 shares you own. But if your stock price stays below the price, strike price, then you get to keep those shares and you still earn the premium. That's great. Now, if the stock price goes above the strike price, you can sell or you will have to sell at the strike price. I mentioned earlier the term is called the shares get called away, and you still get to earn the premium. So one thing I like about selling covered calls, if you've chosen a strike price that is high enough and you're able to keep the shares you already own by all the selling out of the money, there's no guarantee that it'll stay. There are some probabilities involved. We'll take a look at some numbers and formulas to see how that works. I do have a tip over here. It says choose a delta value around 0.3. I remember watching some YouTube videos by a gentleman by the name of Jake Bro. I've included his videos towards the end. And one of the things Jake mentions is deltas of 0.3. And for puts, they're negative values. And for calls, they're positive values. There's like 0.3 and 0.2, which essentially means that you have around a 70% chance that it won't expire in the money, which also means 70% chance of out of the money. And if you do this often enough, so you can't just do one contract and then not make money and then stop doing it. You have to do it repeatedly. If you keep selling covered calls, then there's a high probability that you won't get assigned. And we'll take a look at why you can choose delta to do this, because delta is not defined primarily as the probability, but it can be used as such. But if you choose a good delta value that's pretty low, you won't have to sell your share and you keep earning that premium. Now, just as I described the outcomes of selling covered calls, let's take a look at selling cash secured puts. And both times you'll notice I underlined the words cash secured and covered. That's because when the stock price stays at the money or out of the money, you don't have to buy the shares, even though you set that money aside. you can still get the premium money. And if it goes below the strike price, you have to buy it with the cash that you've set aside. Now, notice I underlined the word with cash. So when you do get assigned, whatever cash you have set aside to buy that stock, you have to buy it. You have no choice. Now, if the price is still falling, it is very risky. And I have some real examples that I'll share in this presentation. So we'll take a look at that. Again, in both cases, you get to earn the premium times 100. So again, for a $5 premium, you earn $100 and you make 500. Here's a tip. There's a field called implied volatility for every option contract. You look at the different amounts, values of 20 and 30, and it's just okay, not that great. But 40 plus is good. You won't always get this. So when I look at the different fields, and we'll take a look at all of them in the option chain, I don't primarily look at implied volatility. I take a look at it after the fact to see how it is. Again, better premiums when the IV is high, but if a contract is already in the money, I definitely don't want to sell a contract at that high volatility, just because better premium doesn't necessarily mean that it's a good deal. So my goal is to make more premiums in the end and not keep getting assigned. So this will be our first break. I know it seemed like a lot of information. So we're at the top of the hour right now. The basics is we covered what are options, we covered the type of options, calls and puts, buying long calls, selling short calls, buying long puts, selling short puts. We specifically went deeper into selling covered calls and selling cash secured puts. Now, before we go into the option chain, I'm going to pause for a second and I'm going to open my phone up to the chat just to see if there's any pressing question before we post it. So I see there's just one fun comment here from Lars. Optimist, actually, it's not so fun. It says it's 227.12. So again, not to worry, Lars. We will cover all the scenarios and what to do when you see the prices at different prices. So right now we're at the top of the hour. Since there's no immediate questions, I am going to continue. And let's go to the next one. The option chain. Now this is a very busy screen. If you thought the other screens were busy, so this one we're going to go through it step by step. Now you'll notice that I've expanded this section here. When you go to the option chain of Fidelity, and if you wonder how do you get there, it's a very long, cumbersome URL. But this link down here in the PowerPoint, it goes to that URL. So if you're logged in, click on that link, it'll take you to the option chain. And you can just search for any other ticker symbols to look at that. You can collapse or expand each of these dates. So let's take a look at the first set. So it's very tiny to see. So I've gone ahead and expanded that area. So it shows you February 3rd, then 10th, and 17th. Took the screenshot, I think, Friday night or maybe Thursday night, maybe a couple of days ago. So whatever days you see, the reason I look at days from 30 to 44 days is because you want time on your side. So as I mentioned earlier, your option buyer buys at a certain price, and they actually want the price to go up. And option seller, which is me, because I don't like buying options, I want the price to go down. So if you look at this chart here, this is called theta decay or time decay. Now, I got this from this website, this simplertrading.com. The same chart is available 1,000 different places, so that's just one place with an article. But you'll notice here, between 30 to 45 days, the price goes down a lot. If I'm the one selling something, if I sell it for, let's say, $1,000 for 100 shares, I want the price to go down to zero because all options expire worthless at expiration. So I have time on my side. And as you know, you can't do anything about time. Time will always pass. Now, the option buyers, they have a tougher time, no pun intended, trying to make money off this trade because they will have to look for a way to be able to sell that option for a higher price. So if they just sit down and do nothing, they will always lose money because then they'll be in a position where their option price is always going down to zero, and now they have to quickly do something. So this is just, all things being equal, the option value normally goes down, but there's a lot of other things that happen, stock price, volatility, things that affect the option price. It can spike up much higher, and then that's when the option buyer will sell their option back in the market for a higher price. That's how they make money. But in my case, I love theta decay because I can sell an option, and I know that even if I do nothing, it will just go down. And if the trade doesn't go my way, the least I can do is I will end up owning some shares that I wanted to buy anyway, or I'll end up selling some shares that I wanted to sell that I'm okay with selling. All right, so down the middle column, you see all these different strike prices. Now, these numbers aren't repeated. You'll notice that these different stock prices only appear once This is because in this version of the option chain, I'm looking at both the calls and the puts. All the different brokerages allow you to look at either the calls or the puts or both at the same time. This is an easy view for me to look at the puts and the calls at the same time. And you'll notice that it goes down from several different values. There's some filters up at the top where I can change how many strikes I want to see. Usually, you'll have some expiration dates available in the weeks ahead, maybe in the next couple of weeks, and then next couple of months, and then quarterly, and then maybe like 1 year later and 2 years later. There are some specific reasons for them setting up certain options. They can't price options for every Friday possible. So in my case, I'm looking at these option prices. And when I grabbed this, I think last week, this says January 4th. So when I grabbed the screenshot, January 4th, it says here that it was $228 and at that time. And then here you can see the different strike prices. So if I want to sell a call option, you'll notice that I'm going to zoom in a little bit here so you can see these light blue areas, the slightly shaded areas. You'll notice that 225 dot something is in between 225 and 230, and this is where the blue colors begin. So that's how you can see the definition as I said earlier about strike price being above or below a stock price for when a call or a put is in the money or out of the money. So as an option seller, you always want it to be out of the money. So let's say if I sell a call for maybe down here for 260, I wouldn't want it to reach 270 because I'm selling my option, my shares at $260. So what I want to do is choose something that's out of the money enough. And we'll take a look at delta values to figure out, do I have to go that far or not? So outside of strike price, let's take a look at the different sections. I mentioned that the area on the left is all the in the money calls for this particular date. And this is for February 17th. And these change all day, every day during trading hours. And then on the left here, you have the out of money calls. This is not shaded. And then on the right side here, this shaded area here is in the money puts. And then finally, out of the money puts. So none of this makes sense if you don't know what all the columns mean. So let's cover each of them and we'll figure out how to choose a row that works best for the trade you're trying to do. So this column over here says volume. So volume, you'll see it has integer values. Sometimes it's 0, right? So there's some in the money option contracts here at 0, and then down here out of the money, they have like really high values, 15,000, right? So let's see what that's all about. So here's a definition and graph for Investopedia, which is a great source of information. So Investopedia says that the volume is the number of option contracts bought or sold in a given trading day. So whether you're buying or selling just for that day. So that's why it can be 0 if no one has bought or sold at that strike price for that date on any given day. Nothing is happening there. But the greater the volume, the more interest there is in the security. That's why you can see like when it's 15,000, a lot of people buying and selling. Well, you might be wondering, well, what is this other number here? It says open int. So that next number here is open interest or OI. And in this case, open interest is also an integer value. But you'll notice that sometimes, even if there's 0 volume, that is today there's 0 trades at that time that I took the screenshot, it shows the value 73 for open interest. Well, who's interested in this? Let's see. The open interest is the total number of outstanding derivative contracts, such as options or futures, in this case options, that have not been settled yet. It just means when you sell to open, or you can also buy to open a contract, then as long as there's new contracts being opened, the open interest number goes up for that day, and it hasn't been closed yet, it's still outstanding the next business day. And in that case, the number will continue to go up. If there's a dwindling number, it's going to continue to go down. So you'll notice that's why you have integer values that could be higher or lower, depending on how much interest there is. In this case, this one has 12,725, obviously a lot of open contracts carried over from previous days. But on this particular day, there were 18 contracts bought or sold. Let's move forward again. I mentioned implied volatility. Now, I'd mentioned one of my tips earlier that 30 or 40 is a good volatility to have. In this case, you'll notice this is all in the blue area. So in this case, if I want to sell a contract, yeah, it looks great. If it's 30 or 40, now let's zoom into that pricing area. Look, I'm making $58 per premium. That's $5,840 just for selling this. Well, at what cost, right? It says your strike price 180. You will get assigned immediately. the delta is 0.9486, which means there's a 95% chance you will get assigned. Whoever's on the opposite end of this will be buying it up, and then you will sell your Microsoft shares for 180. Now, for whatever reason, you just wanted to sell your Microsoft shares for 180, you could do that, and you would collect only $5,840. So again, just keep in mind, all of this stuff is taxable income. So when you make money, options, premiums, you will be taxed for it. So implied volatility is it's often used to price option contract where high implied volatility results in options with higher premiums. So again, high volatility, high premiums, but not necessarily great. Like it says that sometimes, or it's based solely on prices rather than fundamentals. So if you want to own a good stock, or if you want to sell a stock at a price you want, you don't look at just the implied volatility. I try to look at delta first, and then I look at IV to see if that's a good premium or not. And just like the others, I have a link to Investopedia. You'll find lots of links scattered throughout. Delta, as I mentioned, is my favorite Greek. So delta, you'll notice, and some of these have very high probabilities. Now, if I look at the definition, it says that it's the estimate of the change in price of a derivative caused by $1 change in the price of its underlying security. So if the stock price goes up by $1, it is an estimate of how much the derivative changes. So by definition, if the stock price increases by $1 per share, the option will go up by 65 cents per share. And where does the 65 come? If the delta value is set to 0.65. So again, this stuff changes all the time. Anything can happen. I like to look at as this. So if you see the green area, which says a third interpretation of an options delta is the probability that it'll finish in the money. So if it's like 0.3 or 0.2, I know it's a very low probability that it'll be in the money. Most likely it will not get assigned, and I can keep selling more calls, more puts, make more premiums. Same thing here. This is from Wikipedia, and I have both links below. It says here that the implied probability that the option will expire in the money. For this reason, some option traders use the absolute value of delta as an approximation for percent moneyness, as it says. All right, so that's how I like to use deltas. Now, gamma, theta, rho, and vega are additional Greeks. You don't have to read all this stuff. I'll just highlight the areas. I'll read this out loud as well. It says gamma represents the rate of change between an options delta and the underlying asset price. What does that mean? Gamma is used to determine how stable an options delta is. So in this case, the higher gamma values indicate that delta could change dramatically, even with small movements. So if you recall, I had mentioned that delta helps you determine the probability. You might find something has a great probability you like, but if the gamma is really really crazy, that could drive your option price crazy as well. So you want to watch out for that. If you wish, just keep an eye on the delta just to see how it's affected. Theta, we have talked about time decay a bunch of times. Options closer to expiration have accelerating time decay, which works great for option sellers. Rho, which is something I didn't really care about last year because the definition here says it's the rate of change in options value and a 1% change in interest rates. And I noticed last year that my puts were getting better premiums than calls. And I noticed here in the definition, it mentions that interest rates rise by 1%. The call option increases by blah, 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 depending on the row value. And it's opposite for puts. So that kind of explains things. So maybe as interest rates keep rising, maybe I'll see calls getting higher premiums. So we'll see how that goes. And finally, vega is the rate of change between options value and the implied volatility. So again, just like gamma is related to delta, vega is related to the IV. This is how I like to look at it. A rising volatility will correspondingly increase the value of an option. So I don't look at just the vega and the volatility itself. And I don't have to look at the details of all the Greeks for all my trades. I look at the delta first, and if I'm interested, I look at the other details as well. And every contract, when you click on more details, you will see all the values with any group brokerage will provide. All right, so I'm going to rush through this quickly because these are self-explanatory, but you can also come back and read these again. Intrinsic value, it's the difference between the stock's current price and the call strike price. It is always a positive integer value, meaning that in the case of a call, it is the underlying stock's current price minus the call strike price. In the case of a put, it is the put strike price minus the underlying stock's current price. So just to see if someone will be most likely to exercise their option. So that's all you're looking at. So options that are trading at the money or out of the money have no intrinsic value. Only when it's in the money, that's when the Option buyer will say, hey, look, I have some intrinsic value. I'm going to exercise this option. So I'm on the other side of the trade as a call or put seller. And I always like to make sure things are out of the money as much as possible. There's also the time value or extrinsic value. This is what's left of the premium after calculating the profitability of the strike and stop. I mentioned earlier, this is what the option buyer likes to look at. But in my case, when the option intrinsic value is 0, then the time value is essentially just the option price. So these are just some formulas to know, just to figure out, all right, does it make sense for the option buyer to exercise their options or not? So speaking of prices, zoomed into the prices over here. I mentioned earlier that you looked at some of these deltas that are high, premiums that are pretty high. That was the 5,800 all the way up here. But if you look down here, this isn't too bad. I like to look at deltas that are near 0.3. So this one's higher than 0.3. So when went down to 0.24, I would only get a premium of $353 if I sold at the strike price. So if I want to get a little risky and go over 0.3 to 0.31, I could make $500. And if I sold 4 calls, I'd make $2,000 for a 1-second trade. So this is very important to recognize that you can trade or sell multiple options with the same characteristics and just choose the number to be a higher number. So if you're able to sell 4 calls at the same time, 10 calls, whatever you will, I wouldn't recommend selling too many for the same strike and expiration date. But let's say if you sold 4 of these, then you'd make $2,000 right away. And if you did get assigned, obviously you'd have to sell at that strike price. So it's very important to know that you can sell multiple at the same time. All right, so option chain recap. That was a whole lot of information, and that is why we record this, so you can rewatch this again. If you have trouble sleeping, maybe you can watch this tonight and it'll put you to sleep. Or I hope you'll enjoy it. But a recap is the option chain. We covered expiration dates, theta decay. We covered strike prices, the agreed upon price, which you buy or sell the underlying security. We covered in the money and out of the money sections on the option chain. We covered some very important columns, including volume, open interest, implied volatility. Looked at the official definitions and what I find useful. We looked at the other Greeks, my favorite Greek, which is delta, and how it relates to probability, and the other Greeks, gamma, theta, rho, and vega. I didn't think I'd need rho this year, but I guess I'm taking a look at it now just because of the way interest rates have been lately. Next, we covered the values. Again, it's useful to know when option buyer will exercise. All right, so now we are 45 minutes into this session. We have a lot to cover. So I'm going to pause here really quick to see if there's any pressing questions. I will stick around towards the end in case some people want to stick around and ask questions too. All right, so no more witty comments from Lars, so we will continue. So Lars, feel free to jump in there with a funny comment or a funny sad comment, whatever you will. Next, we'll talk about my strategy. So all this time we talk about the concept, lots of definitions. We'll take a look at my strategy with examples. I will hide some things like the total quantity and the number of shares and portfolio value for my own privacy, but and I won't be recommending individual stocks, but I will share some stocks. All right. So I wanted to let you know, and you should all know this by now, you cannot time the bottom. So let's say you're looking at the price going down, you wait, and you want to buy, and you miss the point, right? You try to buy and it goes up, you buy at a higher price. Don't try to time the market. Let's say you try and time the top, hold, and you try to sell. Oops, you missed the market again. So I know that I can't time the bottom, I can't time the top. Now what do? Here's what I do. So let's say I have some cash. I own some stocks, right? I can use the cash to buy more stocks. So now I'll own some more stocks. Most people do this if they just want to get into the stock market. And if you want to play it safe, you buy maybe index funds or ETFs and so on. But you're in this Options 101 course, so you want to do more, right? So we covered cash secured puts and covered calls. You know that you can use your cash to sell cash secured puts. You can use your stocks to sell covered calls. And you do this in groups of 100. You have to have enough cash to buy 100 of whatever stock you want to buy. You have to have enough shares in multiples of 100 to sell covered calls. Now, you can earn premium through both of those, and let's say that starts to add up. You add it to your cash pile. Now, you can keep that cash, or when you realize that your cash secured puts have been assigned, now you own the stocks. Not a bad thing, especially if you've chosen a strike price that works for you. Now, covered calls can also get assigned, and your shares can get called away. Now, if there's anything you need to rewatch in this video, I would recommend watching through as I talk through this workflow because we're doing these animations to help you understand better. On the top left here, you'll notice I mentioned SPACs interest. This is something I didn't realize early on, but the money sits in the SPACs bucket in my cash section, and it earns a little bit of interest. And surprisingly, it's been a little higher lately, more than normal. Nothing to write home about, but I do need to keep cash in the account in order to sell puts. And it's great to have some extra interest along the way. So what about dividend stocks? Now, all this time, like I'm selling calls and puts, and I wanted to buy some stocks to earn some dividends. I did focus on that before in past years. I was just trying to max out all my retirement contributions. So I realized, I can use some of the premium dollar to buy dividend stocks. And I didn't just buy it on a whim. I've had these stocks researched and put into these watch lists, just sitting on waiting. They're setting up triggers all the time. So-and-so stock dropped 5%, dropped 10%. Now, these aren't just any stock that are dropping and not just any stock that have good yields, but actual stocks that I want to buy. So the reason stock is on my watch list is because I've done the research. I want to buy it. I want to own it. And as soon as I saw prices dropping off a cliff in 2022, I thought, hey, why not buy some of these at good price I want to buy? I used some puts to buy them in groups of 100. Some of them wanted to be a little more cautious. I bought them in groups of 10 or 20. So I could have 100. Now, what's the purpose of doing that? The dividend stocks earn some dividend dollars. I take those dividends and use DRIP to reinvest in the same dividend stocks. Again, that's something you have to set manually if you wish to do it. Fun fact, there was a comment earlier in the investment chat that, hey, I don't like dividends, so I don't do the DRIP. Or I think they said that they didn't want to reinvest. So I apologize if I'm getting it wrong, but something about either not liking dividends or not liking to reinvest dividends. So you do whatever you feel comfortable with, obviously. This is just what I've been doing, so I'm sharing mine. So the great thing about these dividend stocks is that I can sell covered calls on these. So that brings around full circle. So I have the cash, I'm owning stocks, I'm selling cash secured puts and covered calls, making some premium money. I can keep that cash, or I can use some of the cash to buy more dividend stocks and earn some money, and then it gets reinvested by a DRIP. And I can use that to sell more covered calls, earn some money. And so you can see lots of circular things over here. There's actually something called the wheel strategy, which is a little part of this bigger picture. We'll mention that briefly towards the end. Now, what are my strategies? So the only two things that I do is sell covered calls and sell cash secured puts. So again, I've underlined cover because that's shares you already own. I don't recommend selling naked calls where you are trading on something you don't already own. You need additional permissions in your brokers to do that. And you can still get the premium. And you may have to sell the shares on or before the expiration date, but you still get to keep the premium. So again, this is a recap of stuff you've already heard earlier in this session. Cash secured puts, you have the cash ready. Again, I'm putting this warning there, don't trade on margin, because if you get margin call, you'll owe money that you don't have in the account. But either way, you get the premium from the put option buyer. You may have to buy the shares at a strike price before the expiration date. That's something that you could try before an ex-dividend date. Now, the ex-dividend date, if you're able to own the shares before then what you do is you can start earning dividends on those stocks right away in the next cycle. Now, the risk is obviously if you end up buying shares for a high price, so let's say you sell some puts and say, hey, I want to buy such and such price, such and such stock as it dips, but then if it dips further, then you own that stock for a higher price. You can close to buy early or buy to close early. And we'll talk about what it means to have an 80% value. That's the value that I like to hit. So buy to close. So here's two real examples. I've changed the symbols to say ABC1 and XYZ1. So it says the current value is minus 300. This is a little tricky. This is an option, a call that I've sold. So the quantity appears as a negative number. If you buy, it says +1 or +2, however many you sell. And in this case, let's start from the right side. It says the cost base is $182.32. So basically for 100 shares, I only made $182, but hey, that's mine to keep. And if it goes above the strike price by the expiration date, which is in some far off distance, then I will have to sell it at the strike price, or $SP at the strike price. Now, what does it mean to have a negative 64.55% loss? It means that, let's look at the first and the last number. So I already made $182. That's mine to keep. But the current value is a lot higher. So this is actually a good thing for new option sellers that come in. Someone just wants to sell another call. They're actually going to get it $300 for the same thing that I got $182 for. So just because it says negative doesn't mean it's bad for everyone. I could be that next person too. I could sell another call for $300 if I wanted to. So in this case, I sold it for 182, but since it's up to 300 now, if I were to buy this back today, if I did buy to close, I would have to spend $117. And that's how you get the 64% number. You take the 117 divided by 182 and saying my loss is 64%. So obviously, I don't want to buy to close. I'm going to let this expire if it doesn't go up any higher. Today's gain loss just shows that today it went down a lot. I think this is like Friday's numbers when I put the presentation together over the weekend. So in this case, I'm just going to let it go. I've made $182. I don't really care about this 117 loss. That's only a loss if I buy it for 300, right? I don't want to buy it back. This one is a good one. I've made $239 on it already, and it says -1 because I've sold it. And it says here that the gain so far is $93. Why is it $93? Because this call option actually has gone down in value to 146. So if I were to buy it back, I would be paying 146 out of pocket. I would still be able to keep $93 of that 239 because 239 minus 146 93. And 93 divided by 239 is that 38%. So I made 38% profit. It's a pretty low percentage. If I just let it expire, I'm going to keep the entire 239. I will make 100% profit. Chances are this is already out of the money. I don't have to sell my shares at all, so I'm good to go. I'll just let it expire. So although it looks like I'm only making 38%, just by doing nothing, and if it's out of the money, I will make 100%. So I do mention here what my thought process is here. 80% gain, you can buy back if you don't want to wait until the day, and you should make use of that time. So if you don't want to wait until the end date, you should try and sell another call or put what have you. In some cases, if I can only make 60%, I'll take it. I'll take what I can get. But for the most part, I would like to keep 100% profits wherever possible. The key thing is don't take a loss. If you keep taking a loss and buying things back at higher values, you're doing it the wrong way. All right, so now it's time to talk risky trades, which is what you're here for. Don't do this. So this was before the Tesla split. The price here is $1,200 per share. And I'm going to mark some points here. A to B, it went up a lot until like $880. It's almost 900. B to C, it was going down a little bit. And C to D, it's mostly flat. This is all of 2021, a couple of years ago, or over a year ago. And then D to E went back up again to $1,200. Well, where am I in this process? So this is actually both me and my wife. We sat down, we're watching the Tesla stocks. Hey, look, it's going up. Look, it's 800 whatever dollars. Let's sell some puts. So we sold some puts at lower out of the money prices and made some premium money. Hey, that's great, we made some money. Let's sell some more puts. Oh, what happened? We got a sign because price went down. So our actual Tesla stock price went below our strike price. And now we're left holding all these Tesla shares, and they're not worth as much as we paid for them. So if you look at C to D, between C and D, we just sold covered calls, sold covered calls. So all of summer of 2021, we sold covered calls and kept making premium until it didn't matter at what point we started selling, because the amount of premiums we made off of those covered calls was more than enough to whatever it went down to. So D to E, we continued selling covered calls out of the money, out of the money. Eventually, we did get assigned, and our shares got called away. And I'm happy to say, don't own any Tesla shares because since then, $1,200, the split three ways. So let's say $1,200, a third of that would be whatever, $400 or so. And then since then, it dropped. It's like 120 or something today. So Tesla is all over the place. So it dropped again a third. So holding these shares would have been bad. It was a good experience to learn. Wouldn't recommend doing it if you don't have nerves of steel. But basically, it went down a lot after we bought. But again, good way to learn. We didn't lose our cool. Sold calls until we made money and sold the shares. All right. This was an interesting one. I wanted to compare my old mortgage, which was last year we still live in a condo. This year, well, actually 2021 we still live in a condo, and we bought a new house around the holidays. And all of 2022 we had a single family house. Mortgage is much higher. So I've removed the actual dollar figures out, but as you can imagine, the blue line says the income that I made from options, because I wanted to try something different outside of Tesla, maybe some smaller trades. But it didn't really get past the mortgage. I wasn't comparing it back then. I made this chart after the fact. The reason you have this tiny little scale is that I have the 2022 mortgage. So As of January, we had a brand new mortgage, which, as you can see, this is a cumulative mortgage. So whatever we paid in November and December of 2021, obviously the cumulative amount in the second month of this chart is double the first amount, right? The first mortgage of January 2022 was higher than those 2 months combined. So again, I didn't know it was going to make this chart this year, but it's interesting how things turned out. Let's go see how it turned out. Started selling options in 2022, starting from a clean slate. So again, this is cumulative for the year January 2022. Coming very close, summer of 2022, and we have surpassed it. So again, cumulative income for options gotten higher than the new mortgage. And by the end of the year, the amount I've made in options is higher than the mortgage we paid on the new house. Now, I have to clarify something. When you sell options, that is not your final income. You have to buy to close or let it expire. So this chart shows the lower amount of the income where after we close, let's say you sell for a certain amount and you have the buy price, you buy back, whatever you have left is your profit. So this includes profits. Now, towards the end, some options we sold towards the end of the year, some of these are not closed yet. If they all expire out of the money and they expire out of the money and also they expire worthless towards the end, then, or we buy it back for a low price, then it'll either stay here or might go a little bit slightly lower, but the amount that it is up right now, I didn't expect it to go lower than that. Again, this was a great experiment that I did not plan on. I made the charts after I realized what was happening because I didn't realize this could go higher until after the summer. All right, let's look at another. We're at the bottom of the hour right now, so I'm going to go through this example quickly. This is two real stocks, A1 and A2. So I held A1 for a while, and you can see the cost basically was below $100. I think it was like $92 or something. I bought in multiples of 100, and it had a pretty low dividend yield. But it's a good company stock, and I was happy to own it. But I thought, hey, let me just sell covered calls on it. So I sold the covered call around June 15. This is summer of last year for $150. Well, that'll be over $50 profit per share. That's over 5,000 profit. So I'm okay with that. I didn't actually expect to sell it, but I got assigned a month later on July 15th. So I chose a 30-day strike and it got assigned. And you see the price over here is at 150. So I thought, hey, what else can I do with this? I can't see the future. I don't know if it's going to go up. See, it went up really high and it went down really low. So I don't know the future, but I thought, hey, let me just sell some puts and buy another stock, A2. And I sold a put for $140. Well, that got assigned too, and that was by choice. I wanted to own this one. I chose that as strike price that I wanted. And you notice here, it's just below 140. It did go a little bit more, but towards the end, A1 is now 125. It's actually a little higher today. I checked just before this call. And A2, it's 163 as of when I took the screenshot, but I think it went down maybe 160 or something at closing today. But again, this is something you can't plan. So the moral of the story is you cannot tell the future, and neither can I. So if you choose stocks which you choose to own at the price you want to sell it at the price you want, just do your due diligence, figure that out. In this case, opportunity fell into my lap. I had A2 on my watch list. It just happened to be within the affordability of the cash that I got from the stock sale. And I was able to sell the same number of contracts and use the puts to buy it. And because of the dividends, it gives me a lot more dividends. And even though the price has gone up, the dividend yield is still pretty good. And I do like it. So if you look at the list of dividend kings and aristocrats, not everyone likes to pick dividend stocks, but if you wish to own some companies you like personally for good reason, then you can do that. So which led me to this chart. So here you will see the dividend income. I just started with this. Aside from the Microsoft dividends, I didn't have a lot of other dividend stocks, except for the A1, which wasn't paying a lot anyway. So I started buying more dividend stocks, as you saw in my workflow chart. So here's what this chart looks like. So you'll see my utilities, which is gas, electric, water, and internet in my new home. And you can see the little spikes here: February, April, May, actually March, April, May, June, July, August, September, October, November, December. So the spikes there are obvious. As Microsoft stock. As I've mentioned sometimes in the investment chat, I tend to hold all my Microsoft shares. My goal is to just hold on to it and pass it on to my children. That way that the cost basis actually gets reset. I'll have my 10-year anniversary of Microsoft next year. So I've had very low cost basis from back in like 2014 prices. So I'm happy to hold it. But the Microsoft dividends gives me a little spike, but I never quite got above my utilities. It's it's expensive to, fuel this house. So, but just by buying all those other dividends with all the other option money, that enabled me to surpass that at the end of the year. So again, not something I planned. I didn't think this was going to happen. But these are actual dividends. It's not, when you go to your dividend view in Fidelity and it says, here is your dividend view, here's how much your estimated annual income is. This is not what that is. This is actually dividend cash paid on each month. So let's say whatever month it was, I just added it per month is actual dividends paid. And these are actual bills paid cumulative for the year. All right, so let's consider this perspective. We are at the bottom of the hour, so I'm hoping that most of you will be able to stay. If not, the recording will continue. Here's the perspective. You may have heard about the 4% rule for retirement, where if you have $1 million portfolio, 4% is $40,000 a year. Well, $1 million, it's a lot of money to attain, but at the same time, 40,000 is not a lot of income from that. But if this is just extra income and you're making 20,000 a year, think about it in a different way. Don't think of it, oh, just a little bit of money. It's 4% of $500,000 portfolio, or 40,000 is equivalent to 4% of $1 million portfolio. And in the same way, obviously, 60,000 is equivalent to 4% of $1.5 million. So regardless of where you are in your retirement, if you are making some side income that's in tens of thousands of dollars per year, it is 4% of some extra portfolio that you don't have. All right, you're able to generate this extra income. So again, you decide if it's right for you or not. If you want, you can rewatch this video with your spouse or whoever you plan with and see if it's right for you. And I hope you find something that works. This was the full diagram again that showed my entire workflow. I won't go over this again, but it shows you the importance of those dividend stocks, why I found it to be important in my journey. My order of operation is I didn't start with this. I started with my 401k pre-tax, did the math, and then maxed it out eventually. But I did start the 401k after tax, the in-plan Roth conversion, maxed it out. ESPP maxed out. I don't sell my other stock awards either, so I have the annual and the special stock awards, which are in different cycles. The IRA, I used to have a Roth, but I have traditional only. It is maxed out. HSA is maxed out. My traditional taxable brokerage, a dollar cost average into index funds and a couple of sector ETFs. Options trading, very recent for me. I did it for 2 years. You've seen the Tesla story in 2021 and the additional ones in 2022. 2023 or ... just started out. I bonds, this was something new. I maxed it out last year just because they had very high interest rates, and individual stocks, which included those dividend stocks. So again, I didn't go into options trading until much, much later. And if people will tell you that either it's gambling or it's crazy or whatever it is. But if you make sure your retirement is planned for, you get to decide with your tax advisor and financial advisor, with your spouse, whoever you plan with, to see if it's right for you. So you may be wondering, wait, how much time does it all take, right? What is the time commitment? I was using this book over here, this book cover that I've seen, the 4-Hour Work Week. The author talks about how you can just work for 4 hours and delegate all your stuff, and it wasn't really like resonating with me. So I thought, hey, you know what? This is my 4-minute work week. I don't have to take a day off to do this. I have a full-time job just like you all do. For me, it's like I do this on a coffee break. I got some interest for the different teams that I work with internally. I've done this presentation 3 times already, and this is the 4th time doing it for a broader audience for the investment chat. So I hope you found some value in this. We want to wrap up with some examples as we've gone over just a few minutes. So if you're wondering, well, how do I only trade for a couple of minutes per day, right? Because I can do multiple calls, multiple puts at the same time. And also I do some after hours trading. They're not really after hours, so I have in quotes. So this is 2 real examples. So on December 13th, just before the holidays, we're expecting some CPI data. So, before we took the baby to sleep on Monday night, I just sold some covered calls with a limit order instead of a market order. We'll take a look at what that is, and enter some premium dollars that was higher than what people were asking for, which is the bid-ask spread. And it got filled in the morning. The stock price went up a lot in the morning, and it got filled when the market opened 9:31. Again, I didn't know that was going to happen, but I anticipated, hey, maybe that could happen. If that would happen, it would be nice. So I did that, and it got filled. Made some premiums off of that, and then later on, I did expect another rally that didn't happen, the so-called Santa rally. But more recently, week of January 9 to 13, which is this week, Powell will speak on Tuesday, which is Jay Powell, the Fed chair. And there's some CPI data coming out on Thursday. That's the monthly data. So what I did was I sold some covered calls. This was before the weekend, January 6th. Again, did a limit order, higher premium. That got filled this morning. So again, very busy day at work. I didn't have to do anything during the day. I had this call set up on Friday night, and then they got filled this morning. So a recap of my strategy, I showed you my complete diagram, my tips and strategies, particularly for covered call and cash secured puts. We did an option, an example of buying to close, where we showed the terrible example of Tesla in 2021, compared the options income to mortgages and the dividend income to utilities. Oh, I did mention interest here as well. If you remember the SPAC's interest, the cash doesn't earn some interest. So that the dividend chart showed includes the interest as well. I want to mention that here. A1 versus A2 was the example I showed with the two charts. My order of operations, which is what I chose to do because I didn't want to put everything into options. I didn't even know what options was when I started at Microsoft almost 9 years ago. Finally, the time commitment, just to show you, I spent not much time at all, and maybe during a coffee break, I can make some trades. I do some trades after hours. Again, it takes a few seconds, but that does not preclude you from doing research. So on your own time, whether it's a weekend, weeknight, whenever, what have you, do your research, learn about companies you wish to buy and sell. I showed you an example of after hours limit orders, okay? So at this point, I will quickly take a look at the chat on my phone. No new chat, that's great. Let's move on. So now we're just crossed over the 1 hour mark. This covers all the main parts I wanted to show you, but how do you actually do this in Fidelity? There's some videos out there, but I wanted to show you the latest and greatest. These are screenshots that I took late last night on Sunday night. So when you log in, you may notice there's an account features on the top. If you can't see it, just zoom out a little bit or click the dot, dot, dot. Under brokerage and trading, there is an options area. You have to apply for this. So notice over here, it says personal info, employment info, blah, 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 options tier. That's where we're at. So you can fill out your own info. But in the options tier, I just selected high just for the heck of it. But really, the things that I need over here is this from tier 1. They used to have like multiple levels where you had to choose level 2 just to do puts. But now I can sell calls, I can sell puts, all in tier 1. I did mention buy rights briefly earlier. If you don't already own the stock, you can simultaneously buy the stock and buy the covered call right away. You can roll covered calls, which I'll explain a bit later. Buying calls and puts, I mentioned that as well. Straddles and strangles are a little difficult to understand, so I will mention that in a long list of things that you should do more research on. So once you get that enabled, you wait for your approval. It might take a couple of days. You might have to call Fidelity. Make sure you go to your account features and under brokerage and trading again, look for cost basis information tracking. What that does is it lets you see your default disposal method. So you can click on the first one or whichever one you want to change. And it's usually set to first in, first out. You can change it to whatever works for you. I chose tax sensitive. I have all these different Microsoft shares and other shares at different prices. They're all over the place. But whatever works best for you. Again, work with your tax professional and your Fidelity advisor to see what works. So we've seen this before. This is your option chain. I've set the filter so it shows a fewer number of strikes. So let's try to do a real trade over here. I took a screenshot. I didn't actually complete the trade here, but see how it says sell to open, buy to close, sell to close. So you can do all 4 of those here. So let's say if you're an option buyer, you would do buy to open. If you're the option seller, you do sell to open. I don't like doing buy to close from this screen because you're not looking at whatever you already have open. I want to be able to see that in my position. So right now, we're doing a brand new option contract. You do sell to open. In this case, let's say I chose 230 as a strike. And if I look back, so this is why I'm go back to Lars's comment. It says price is 227. So let's say even if I sell at 230, making extra $3. But if it goes higher than that, I would be missing out, right? So let's see what this means. It fills out a lot of the info when you fill it when you select it directly from that option chain. It already says an account where you have to select the account where you hold your shares you want to sell the covered calls from, because it might not select the correct one. So make sure you select that. And then over here, because I've selected it, it says I have this many shares of Microsoft owned in cash in this account. Now, I already own the shares over here. If it didn't find it, then it would say it was not covered. But in this case, it is covered. And I can sell 1 or more. As I said, you can sell 2 or 4. It does not take extra effort. I'm selling 1 over here, 1 call. And then I can choose the order type of market. It's just going to pick whatever midpoint of the market price. So right now, my bid price is $7.35. Ask price is $8.25. It means that buyers are bidding $7.35. Sellers are asking for $8.25. If I select market, most likely I'll be settled at $7.80. If But here it's showing me the max gain if I went with the buyer's bid prices. It's saying that for $7.35 times 100 shares, the maximum gain I can make as an option seller is $735. The max loss, as you've seen from the chart, is unlimited. Why is it unlimited? It's saying that if I sell the Microsoft stock for $230 and tomorrow it becomes $1,000, which won't happen, then the max loss is unlimited because, oh my God, I could have sold it for a lot more. So it's really the fear of missing out. So if you choose a good expiration date, you don't expect it to go that high anyway. Don't worry about the max loss unlimited. It looks a little scary, but it's just saying if it goes up super high, then you're missing out. So if you're not comfortable with that, do not sell a covered call at a price you're not comfortable with. Your break-even price is $237.35. Where does that come from? It's 230 plus 735. Because if you remember in the chart, break-even is your strike plus whatever premium you're getting. Well, the estimated order looks a little higher at 779. That's because most likely when you choose market, you will get assigned the midpoint at 780. So the estimated your premium you earn is $780, and you have to pay a 65-cent fee. That's a fixed fee per trade. And the cool thing about this fee is that when you buy back, and if you're buying back for just a couple of dollars, that fee gets waived if it's really small. So someone is asking, I've been able to join. Is it being recorded? Yes. I'm just going to say yes. All right. Now, next you do preview order and you can confirm the order. So that really explains everything we covered this far when you're selling a new call. But wait, what about the other types of orders? There's a limit order, right? So a limit order, you can actually choose, let's say you want to select the midpoint, which is kind of pointless because the market order will most likely select the midpoint. Well, you could select the ask price. You might not get filled immediately, so you might have to wait. And if you don't care that you don't get filled immediately, you can set the ask price to like $10 or something more. So if it's $10, that's $1,000 premium for 100 shares. So it's nice to have. So that covers the order type, and then you set the limit, set your price, and the time in force. If it's day, it just means that you set a limit order, and if it doesn't fill, you have to do it again the next day. I like to choose good till cancel if I don't want to keep looking at it. I'm a busy guy, and I'm sure all of you are as well. So as long as you feel like you have to keep looking at your phone or looking at your laptop, you're doing it the wrong way. I do it this way where I can do this after hours or before hours and I don't have to look at it. And if I get a notification of something on my watch list that's going up and down, I can make a quick trade. It takes a few seconds. So let's close this up with buy to close. So I like to do buy to close with your positions tab. And if you select buy to close directly from a position, so obviously here I'm only looking at one position, but under positions, you will see all your positions and all your accounts. You can filter this by other accounts too. So in this case, you choose buy to close, and what it does is pre-fills all those values. You can choose the bid ask price, you can do the limit price and all that. If you do market price, it'll buy to close immediately. Just make sure that's the price you want to close at. You can calculate ahead of time. Let's say you got a premium of $1,000 and you do want to make that 80%. You want to make $800, right? So what you do is you can do buy to close and set a limit that you want to buy it back for $200 and just leave it. And if it hits, it hits. You make 80% profit. If it doesn't, then you just keep your trade, or it closes worthless. So when it's worthless, it means that you've kept 100% of the premium. So that lets you enjoy your life and not have to worry about this. If you have to worry about your trades, this is not right for you. All right, so what's next? So I've covered everything I wanted to cover. We're just 15 minutes over. And it says here that rolling a call, you can roll up. Like, let's say you don't like the call that you have, or you just want to close it out, but you really want to make use of that time because now you have all that extra time you've gained back. You can roll up as in choose sell it for a higher strike price. You can roll down, sell another call for a lower strike price. You can roll forward, where you sell another call for a future expiration date. Obviously, you can't sell it for a past expiration date. Wheel strategy, I had mentioned it briefly before. That's when you sell a put, own some shares eventually, sell a call, sell some shares eventually, and you repeat, and that goes around and around like a wheel. And then depending how you're feeling about a stock, neutral, bullish, or bearish, a bunch of other options that are available. If you remember, there are straddles and strangles that are in the level 1 of options trading in Fidelity. Again, that's because these are neutral strategies. The bullish and bearish that are a little more complicated. So these are things you can just search on the internet or on YouTube to learn more. So the recap of Fidelity options trading was how to enable options trading in your account, set the default disposal method so you have the appropriate tax treatment, how to sell to open, how to set up market orders and limit orders, how to buy to close, and what's next. So for more information, I did mention this dude, Jake Bro on Twitter. He doesn't have a lot of recent options or finance videos. He covers other topics as well. So I put some links on his old playlist. This explains things very well. So as I mentioned earlier, my wife and I have been doing options trading for a couple of years now. I wanted to find some videos that explains everything that I know so far and then some because I wanted to learn more. I found that his playlist, aside from these 4 videos, have all the information that I ever wanted to know. That's super useful. I have some links to Investopedia, but throughout the whole presentation, I've included links to Wikipedia as well. So hopefully you find all the links useful. Just want to replay my disclaimer over here. You should consult a financial advisor or a tax advisor. I'm just a Microsoft employee like you. And this presentation is not financial advice personally for you. And the slides here only represent my personal experience and knowledge. And of course, to end it all, past performance is not a guarantee of future results. So